Thanks everyone for joining. My name is Benji. I'm from Sightline Climate, and I'll keep this intro brief because the report is what you all came for. For those of you who don't know us, Sightline is the market intelligence platform for climate and energy. We combine proprietary data, expert research, and AI to help utilities, investors, and energy companies make decisions. Today, we're walking through our flagship 2026 dry powder and new funds report, which went live earlier this month. It's our comprehensive look at where climate capital is being raised, by whom, and what's left to deploy. We got write-ups on this research in Bloomberg, Semaphore, and the Wall Street Journal, and it's making the rounds on LinkedIn. A few headline numbers to set the stage. 90 billion in climate dry powder remains as of Q1, but exit times are stretching and LPs are getting more cautious about fresh commitments. Mega funds are pulling away from the pack with 193 billion, or 75% of all capital raised, concentrated in just 58 funds from the top 10 investors. VC's share of climate capital has compressed from 20% in 2021 to under 8% today. And in a striking reversal, Europe outraised the US by nearly 2x in 2025. So there's a lot more research underneath those numbers. Julia, our head of research, she led this work and she's going to walk us through what that all means. One little bit of housekeeping. After Julia presents, I'll throw questions at her. We'll play a quick game, do some overrated, underrated, and then open it up to audience questions. So Julia, I'll pass it over to you.
Thanks very much, Benji. It's really nice to be with you all, especially since it's actually been a little while since we did this report. If you've been following our work for a while, you know that the last time we were talking about the climate capital stack was back in 2024, and quite a bit has changed there. We have been doing a lot of work on tracking more of these funds. You'll remember that last time we introduced infrastructure funds. That's a big part of what we've seen this year. And we're just in a pretty new paradigm. Everyone is talking about data centers and how that relates to energy and all of these enormous mega deals that we are starting to see go to the leading players. So I'm going to talk you through a few things. First of all, this is me. I lead research at Sightline. And this report is really the work of that amazing research team. So huge kudos to them. And I'm really excited to be presenting their work to you. So the first thing we're going to go through is dry powder and funds. I'm going to tell you where the money is coming from. Then we'll talk through some investment trends, so where all of that money is going. I'll give you a sense of what we're watching, what we're thinking about in terms of milestones and things to look out for in 2026 to get you ahead of what's coming. Benji and I will have a bit of a chat and then we'll go through any of the questions that you have. So please drop some questions in the Q&A box. I would love to know what you guys want to know. Okay, dry powder and funds. So as Benji mentioned, that $90 billion is our headline. That is all the money that is still there, ready to be deployed for climate tech. That's accounting for everything that has been raised. So we've been tracking that AUM, and then we apply a typical deployment timescale to that. So that's a huge number. That's a ton of capital that's available for climate tech. We're going to see some really cool stuff come out of it. But something I do want to talk about is the shape of the top of this curve. So you can see that in 2022, we had this massive increase from previous years. So the dry powder and AUM really jumped together. That was kind of the peak hype cycle for a lot of climate tech. Everybody wanted to be in there. You got a bunch of investors who'd never done a climate fund before diving in and wanting to see what was going on in the space. We haven't seen that kind of abundance of enthusiasm since then. Then there was a lot of time spent finding places to put that money, figuring out which startups they should fund and who was going to be the leader. We did see a few other peaks, and that's really when more of the infrastructure players started to get involved. So they have been also driving the very top of this curve, and they're the reason why it's so high. So let's talk a little bit about those vintages and what was happening year by year. So 2025 fundraising, as Benji mentioned, was actually a record high, and it was driven by these enormous energy infrastructure funds. Some of them generalist. That's our term for if a fund just is raised, and they include climate as a part of it. So maybe it's like digital infrastructure and climate, or digital infrastructure and renewables, um, those kinds of funds. And then we also have climate focused funds. And a lot of infrastructure funds are raising climate focused funds as well. Brookfield is a really notable example of that. So 2025, a record year, 92 billion in new capital raised across 179 funds. That's twice what was raised in 2024 and 85% more than even in that peak of excitement in 2022. So there's a huge amount of capital from the recent past that still has to be dispersed. A lot of the 2021, 22 vintage, that has already been spent. We've talked a bunch about infrastructure funds. So infrastructure funds made up 77% of new climate AUM in 2025. So they were about 330 billion of the total that's been raised since we started tracking this, about 63% of the total capital that we've seen. It's interesting to look at these numbers as well because you can see that it's very peaky. And a lot of that has to do with the mega funds. We also took a look at what these funds were focused on, what they were planning to spend the money on. Energy was the primary place that people want to put their money. That's about 75%. And it's really because that is the part of climate infrastructure that's really become very mature. So a lot of infrastructure funds very comfortable saying, yeah, I'm going to do wind and solar. I know how that works. I can see the project finance there, all good. That's a big change from where we were in 2020. Back in 2020, energy was only 5% of funds being raised. That's because that was really the beginning of this deep decarbonization cycle. Everybody was talking about fuels, they were talking about transportation, about EVs. Wind and solar were seen as something that was like already infrastructure ready. So it was like out of the VC world, but maybe wasn't quite ready for massive infrastructure funds. It was still reliant a lot on policy measures or maybe some government grants. The thing that we are going to be watching for a lot of funds is what happens in this built environment data centers sector. There is definitely demand for greener, more sustainable data centers that don't use as much water, that are energy efficient, that are being powered by clean power. And we're waiting to see if there are going to be very many funds announced over the next year or two, really trying to fill that niche. So the investors here are a really interesting piece of this whole strategy. A lot of these funds were pretty concentrated in this top end. So the top 10 investors are usually a huge portion of the total. And you can see here that Brookfield is like far and away has closed the most funds since we started tracking in terms of a dollar amount. A lot of those Brookfield funds are actually oversubscribed as well. So we often hear, oh, this much more, because so many people want to put money into climate with a trusted partner. Then you've got funds like Copenhagen Infrastructure Partners, which has really taken on climate as their new normal. So they will raise infrastructure funds and it won't specifically be labeled as like green or climate, but you dig into it and actually it's entirely for renewables. So it's a real show of confidence in wind, solar, batteries as mature infrastructure. A lot of these other names, you'll notice that there's a lot of European investors and Brookfield, of course, the Canadian investor. So they were leading not just in the totals raised, but also in the close rates. So it's really a story of how Europe and the rest of the world is coming into its own. Infrastructure was far and away the growth story here because there are like more and more players coming into this. You can see the explosion in the number of logos that we have here and just the steady growth in the number of funds. So 12 in 2021 rising to 42 in 2025. There's a lot of groups that are bringing climate into their infrastructure portfolios and raising funds that include it. This may be the last year that we do these logo slides because it's getting quite difficult to cram everybody onto them. This one is just about readable, but we're going to get to the VC one in a couple of slides. And if you can find yourself there, you have better eyesight than me. So I want to talk about the top of the funnel. So infrastructure is driving this. That's great. It's a ton of funding for climate, but venture capital is really drying up. So you can see that that green portion of these bars, the AUM in each quarter, the dry powder available in each quarter, is really drying up. It's really shrinking. We've been hearing for a while that it's super tough to raise out there, and that's going to make it hard for a bunch of these infrastructure funds to find projects to feed that later stage pipeline. Because if they don't have VC commercializing and providing folk funding for a bunch of the new tech, then you're just going to see more and more concentration in a few technologies, and you won't really have that growth of a brand new market. So you can see that there are still a lot of VC funds being raised. So 2025 is actually pretty close to 2024's total, and it did go up from those earlier years. But the important thing here is the size of the funds. So they are getting smaller. They were about $160 million on average in 2025, which is down from 174 million on average in 2024. What we're seeing from VC funds is that it's a bunch of groups who have been in there for a while. They have LPs that understand their model and trust them, and they're raising again. But also that the funds are getting a lot more specific. Like you will find one that's specifically focused on, say, forestry, or something that's specifically focused on adaptation. So it's a real question of like, where can you find the niches here that people have very specific interests in? And then how can you raise a fund specifically around that? So I think this is a trend that you'll keep seeing in VC is a real focus on something that is very much needed in the moment and probably some smaller fund sizes. So it might look like VC has really been struggling, but there's actually a lot that can be done on the margin, the things that really feed into the key investment themes. So it was a really good year for a bunch of climate tech that was able to feed into these ideas of we need to get more clean power on the grid. We just need to get more of any power on the grid because all of these data centers want to use it. So that was really the grid tech funding that was up 12%. That was about how much more power can you just pump through the grid? How much better can you understand the grid so you know how to manage it? And then can DERs that basically doubled their venture funding, how can they provide the flexibility or the security and resilience that individual consumers want when they've seen their power going out? Nuclear is riding off the back of a bunch of big raises in SMRs that are tied to a lot of these data centers. And then, of course, we're starting to see more and more extreme weather, most notably wildfires. That the funding for that tech is still pretty small compared to these enormous deals that we've seen for nuclear, but it was still up 69%, which is really meaningful in terms of 2024 to 2025 change. Benji hinted at this geographic focus that is also in line with a lot of the trends that we've been seeing, but now we finally have the hard numbers to back it up. So if we look at funds from a geographic focus, Europe is leading in both fund value on the left and fund count on the right. A lot of this is infrastructure, and we have tallied and sorted these funds into different geographies based on the investor rather than where they're going to be deployed. But most of these big investors, especially if they have a tie to a pension fund or the government, have a mandate to spend at least some of that money in Europe. So that is clearly going to be a lot of new funding that's available to European startups, European infrastructure projects, European climate funding. I do want to mention the big yellow segment because it's very large for an other segment. That is basically Canada, which is Brookfield, and then also Kenya. So it's super interesting that we're starting to see emerging economies also raising climate funds and also thinking about how they want to remake or just make in the first place a lot of their infrastructure. So this is really good news for Europe, this change, and it's a leading indicator of the shift that we've been hearing about for a long time away from the US. A lot of investors are saying, I want something that's more stable. I want something where I know there's policy support, and that's basically Europe. So when we've been tracking investment and deal counts, it's a very different picture if you look at the amount of investment versus the deal counts, because on the amount of investment, the US is definitely winning. So last year, the US had double the funding in terms of VC that Europe did. So twice as much money going into startups headquartered in the US than startups headquartered in Europe. But if we look at it in terms of deals, which is what I'm showing you on the screen here, you can see that Europe actually had more. There's a ton of innovation in Europe. There's a lot of startups. They just consistently receive smaller deals. So they're really just losing out on deal size. We started to see that turning around with the mega deal from Nscale. That was really a signal that there is appetite to be spending $1 billion for a Series B in Europe. And so if they can direct a bunch of those funds that have been raised in Europe to the startups there and become as ambitious as their funders, then they're going to see a really huge transformation. And something that should give all of those investors and funders confidence is that Europe has a lot of policy backstops. So this slide is showing you about CBAM, which is the Carbon Border Adjustment Mechanism that Europe brought in and is now in effect. So we did some analysis on how much that Carbon Border Adjustment Mechanism, which is basically a carbon tariff on any aluminum, cement, ammonia, or iron that is coming into the EU, what effect that would have. And you can see that the numbers are pretty stark, even for this year. So 66% more costly cement coming in from Turkey, 10% more expensive ammonia coming from Russia, 41% more expensive iron coming from India. So this is going to push a lot of industrial decarbonization technologies in Europe, because at the same time as the tariff is ramping up, the carbon prices on domestic producers are also ramping up. So people are going to want to buy more of their materials domestically, and they will have to get cleaner or else face a pretty big carbon price. So not only is there the innovation ecosystem in Europe available for all of that funding, but there is also the policy backstop. Europe has been pretty consistent on its climate policy, and we do expect that to continue, even with all of the geopolitical disruption that we're seeing. Okay, let's talk about investment trends. Let's talk about where all of the money is going. I love showing this slide because I love a happy story. And last year in 2025, we actually saw climate tech funding rise 8% to just over $40 billion. The interesting thing is that deals didn't go the same way. Deals fell to a 4-year low. And what that means is that all of this funding is being driven by mega deals. So we have mega funds, we have mega deals, just a lot more money being really concentrated. And speaking of concentration, there were really two sectors that were driving that increase in climate tech funding. They were nuclear, which you can see in the blue, and green data centers, so low carbon data center funding. Together, these two made up 27% of funding in 2025. So that is a pretty enormous slice compared to where it was in previous years. So you can see 18% and then single digit percentages beforehand. So these are the two themes that are really driving a lot of investment. So there's concentration in terms of sectors, and then there's also concentration in terms of companies. So just a few companies made up the majority of the funding in key sectors. So even in some of the biggest ones, so for data centers, it was really Crusoe and Nscale. They made up more than half of all of the funding for that sector. And then China Fusion Energy, which is China's champion for that technology, taking 42% of all the funding for fusion. Same story for things like nuclear and for geothermal. Grid technologies is a little bit more spread, but you also have a lot of winners that are starting to emerge there by who's working with utilities and who's working with hyperscalers. So of these two themes, we've been tracking what's happening on the project side, on the offtake side, and we're not really seeing any signal that it would ever slow down. So we've tracked 100 gigawatts of data centers that are planning to come online by 2032. So this is an enormous pipeline. You can see that classic up and to the right curve. We have said that we think there is a little bit of caution that's needed here, because if you look at what's in construction in that green bar, You can see that it's not as much as the 16 gigawatts that we've said for 2026. So probably not reaching quite these highs, but if you want to know more about that, we have a great de-risked pipeline that you can read where we give you our view on what will actually come online. And then on the nuclear side, this is really closely connected to these low carbon data centers because it's all of the investment, all of the excitement, it's being driven by deals that these nuclear companies have made with hyperscalers. So Google, Amazon, Microsoft, Meta, they're all betting that they're going to still be deploying massive amounts of data center capacity in the 2030s. And they are putting in place the agreements that you can see here to buy all of this power so that it's secure in the future. I'm going to wrap up with what we're watching, and then we can get into a bit of the discussion. So I wanted to give you some milestones and some indicators, some things that we've been thinking about that you can also keep an eye on to keep on track. The first one is Europe's growth stage deals accelerating. So when we look at European startups, they really get stuck in the Series A, Series B kind of realm. But Europe has the funding that the ecosystem needs, and now it just needs those growth deals. So we saw that 1.1 billion Series B for N-Scale. You should watch for more and more of these billion-dollar deals or just a lot more later stage growth funding, because that would be a signal that it's not just the early stage money that is willing to come to Europe, it's real infrastructure going to be built out. The second thing I've called infra funding innovation. So while most of these infrastructure funds have focused a lot on the things that they know well, the wind and solar and batteries, we have started to see some project finance, some debt, some of these deals being done with what I kind of think of as like Gen 2 climate tech. So geothermal and Fervo or SAF with Infinium. These are new technologies, they're deep decarbonization, and they have started to receive later stage funding. So if that massive pink infrastructure bar can start to direct its attention not just to the energy sector, but to all of the other sectors as well, to industry, to agriculture, then we'll start to see real shifts in terms of the climate prospects. The third is focusing on climate co-benefits. We have seen that some people are already stretching to see what they can consider as climate tech. So what about the supporting infrastructure? What about something that makes something more efficient? Climate tech originally billed itself as something that was focused on security, on domestic production, on something that was more reliable, had lower volatility than another solution, or it was simpler in the case of EVs, and it wouldn't break as often. And that's what we're going to see now is a lot of climate tech getting funded more because of its co-benefits, security, resilience, and less just on the fact that it has lower emissions. I mentioned 200 billion. When we were looking at all of these funds, we discovered that while we were just showing you numbers of what's closed, there's another 200 billion out there that has not closed yet. So these are funds that have been announced, but they haven't reached their close. So if all of that money is still in the pipeline, is still moving through and could reach close fairly soon, that's a huge indicator that there is still appetite to fund climate. And it's just about when and whether it does, that's going to be a real bellwether for the industry. Software as a service is out, hardware is in. AI is disrupting just about everything right now. And we've heard people say it's going to eat software. We don't want to do software as a service anymore. We want something that is a project. It's going to have returns. We can calculate it. We know what it's producing. Kind of back to basics in terms of the things that they want to fund. So it's looking like hardware is kind of back in the picture after being pushed out of it for a little while as people looked for software plays that could get them returns faster. But it does come with the need for much larger deals. There's a lot of capex that has to go into building something, and then longer timeframes. This is typically something that you would see a very patient investor doing. And now you have a lot more people looking at that hardware space. And the final thing is watch for that climate percentage to rise. So we talked about generalist funds earlier. When we make all of the charts in this report, we assume that for a generalist fund, so one that just has climate listed as one of many things of what it will invest in, we assume that about 30% of that fund is going to go into climate. And when we've looked back historically at how these funds have been dispersed, it's pretty much 30%. That's why we use the number. But if we start to see that growing, if we start to see generalist infrastructure funds spending more and more on renewables, then that's going to show that not only has the sector matured, but it's actually replacing traditional assets. And that will be a really big boon for the industry, and it will really signal the shift that we have all been waiting for. Okay. I'd love to bring Benji back and we'll get started with the discussion.
Okay. First thing right off the bat, Julia, thanks for this beautiful presentation. How's this different from our last report, the 2024 Climate Capital Stack, which came out right at the end of 2024, if I'm right? And so it was really it's really only like a year and change since we put that out.
Yeah, exactly. I mean, the big change is that we added a lot more funds. So we were upgrading all the systems that we use. We were checking in more with investors, and all of that meant that we found some funds from previous years that we added in. So if you have these two charts next to each other, you'll see that the historical numbers are a little bit higher, maybe moving around a little because we found some new deals too. So basically, more funds, bigger numbers, and definitely a very different perspective from the investors than we had in 2024.
Okay. Let's dive into that a little bit. The big theme here is the rise in infrastructure funds. How do you see that impacting which sectors are moving forward?
I think there is going to be a huge focus on mature tech. So I don't see renewables, batteries slowing down anytime soon. But I think the question is, if you are not one of those huge deep-pocketed infrastructure investors, then what do you do? If you can't afford to be like putting hundreds of millions or billions of dollars into a project. So I think that's when you see a lot of people looking at how can you serve the supply chain or how can you serve the margins of the tech. And that's where you'll have VCs looking at how can you optimize the grid or optimize renewables. So maybe a little bit of software or robotics, thinking about, all right, how can I automatically clean solar panels? How can I do predictive maintenance on wind turbines? Exploration for geothermal will also be something where you can see a VC play, or the materials that need to be developed for all of these new nuclear technologies. So I think we're going to see a lot of the things that are not related to this massive build out of power and the energy system being a little bit quiet unless there's a really specific policy push in a region. So, say SAF in Europe. So, huge focus on energy, big focus on the infrastructure, and then a long tail of everything that supports it.
Okay, well said. But I think a lot of people tuning into this call are probably interested in the long-term impacts of what we're seeing in VC funding and a decline here. So especially the CTVC crowd. So what do you have to say for them?
It's definitely not going away because without that steady stream of innovation and without this missing middle funding, there's basically going to be a limit on what you can do in terms of emissions reductions. So when I was spending a lot of time 10 years ago thinking about the power sector and how that was going to decarbonize, we would talk about 80%. So we'd be like, yeah, wind and solar, renewables, they get you to 80%, 80%. But then what do you do after that? What is the other 20%? We don't really hear about ag anymore. Industrial decarbonization is slowing down. We're going to reach a point where we basically haven't developed the technologies that we need. And so the options are to basically try and like fast track them when there is policy support again, or when the effects of climate change have just gotten so extreme that we need them, or you turn to adaptation and removals. And on the adaptation side, we're already seeing that. We're seeing people say, like, we have extreme weather, we have wildfires, we have a huge amount of risk that the insurance industry is trying to deal with. And so let's put money into that because that's something that people will pay for. There is a lot on the adaptation and resilience side that needs a lot of development. and even individual consumers are willing to pay for.
I feel like that answers my next question, which is where is the VC money actually headed?
Yeah, I skipped ahead a little bit. But the other thing is that there's just a huge amount of demand for data centers. So if you have the fund size for it, there's going to be more demand for nuclear tech and geothermal. I'm already hearing people say, like, who's the next Fervo? Where should I be looking? But it's those smaller plays and adaptation that are super interesting. And it's not just about the physical side of things either. What I've started to see playing out that's super interesting is that all of these climate monitoring or management software companies, they've collected a ton of data on the physical world. And that is gold for an AI model because what it really needs is information that you need sensors in the real world to be collecting in order to predict what's going to happen. So I think you'll see a lot of this idea of like tracking climate now becoming a foundational model for AI.
I love that. Okay, quick game. Rosebud thorn. Roses, buds, and thorns, maybe plural, depending on which side of the pond you are. Rose is what's really good signal we saw in the past year. Bud is what makes you optimistic for climate finance as a whole, and thorns is what's concerning and what should we be watching out for?
Okay, I'm going to start with the thorn so that we can end on a good note.
Okay.
The thorn, I think, for me, the thing that I am a bit worried about is how concentrated a lot of things are in the climate space right now. So the funding being concentrated around this like data centers play, around nuclear. And then if you look at the groups that are doing the funding, you see the big infrastructure players accounting for such a huge portion of the capital stack. It basically means that if there are any small shifts in these industries, there's huge ripple effects and a huge impact on deployment. So I'm a little concerned about concentration. I love to see that being more diverse, but I think there are some good signs. So my rose is that the numbers are up. So even if in some cases the dollar figure is down, like VCs, like the number of funds is still pretty high, and that's all about momentum. What I also think is really good news is the interest in emerging economies like India. India has been popping up on my radar a lot more in terms of IPOs, in terms of funds, in terms of cool companies. At our New York Climate Week event last year, people were talking about how money can go much further in those economies. And they're also crucial to decarbonization because that's where all of growth is. So building a lot of the new stuff, if it's low carbon, then you lock in those emission reductions for the future. And then the bud, the thing that I am like watching, optimistic for, I think it's these climate tech generation two companies raising debt. So that means there is still a lot of progress. There's a lot of that that's being driven by corporate offtake. So that is a huge portion of this. Generally, the way it works is you announce you're going to build a project, you get a bit of VC funding, you get corporate offtake, you get some debt. That's inherently unpredictable unless you have something like a SAF mandate in Europe. So it has to be watched really carefully. But I think it's interesting to see how a lot of clean projects are positioning themselves as a way to get fast power or a way to get reliable power. So I'm basically watching that and to see what the pension funds start doing because they were early investors in a bunch of wind and solar projects. They're very patient capital on a huge scale.
Something you mentioned to me just briefly while we were putting this together was that this really does surface some interesting LP information that maybe is not immediately in all of our reports in Sightline, but sort of brings that to the surface with this report.
Yeah, the LPs are a really cool part of this. A lot of development banks and a lot of people with an interest in infrastructure, not just in the US and Europe.
Okay, so speed round, overrated, underrated. I'm gonna call something out and you tell me if it's overrated or underrated, okay?
Okay, I'm ready.
Okay. First one, wind and solar.
Oh, I'm gonna get so much flack for this, but I think it's actually overrated. And I'm gonna explain so we don't have to get too controversial. I think people are getting a lot of credit for investing in wind and solar when really that should just be obvious now. It's the lowest form of new power in so many places that it's like we have to move beyond this. It's not going to solve everything, and we need to focus on what is after that. And there's some great technologies that should be being scaled.
Okay, spicy take. Next up, first of a kind projects.
Oh, first of a kind projects are the toughest and the most important. So I still think they're underrated. I hear from so many people that they're like, we don't want to be a first mover. We want to be a first follower. Well, somebody has to go first. And I think a lot of these big funders, and especially on the LP side of these funds, I think they need to be a bit more aggressive because there is actually an advantage to being first for a lot of the people in this value chain. Like for off takers, if you're in first, you can often get like a lower price than maybe the off taker who comes in 10th for a folk project. You always want to get in early with a huge winning company. I think it's time to take a little bit more risk.
Okay, love that. Okay, next up for overrated, underrated, government finance.
I think overrated. It's way too predictable these days. Like policy changes, even in Europe, where you start to hear about like rumors about the EU ETS. I think if you're relying a lot on government finance, it's going to be tough.
Okay, and this one is my favorite of all. It's just one word, Europe.
The entire continent.
Yeah.
Um, I really think Europe is underrated. It has been a solid place for climate and for innovation for years. It has amazing universities. It has a great ecosystem. It actually deploys stuff because it has a solid carbon price. I just think that they need some help from you, Benji. They're really bad at marketing. I talk to VCs who are like invested in US companies and invested in European companies, and they're like, oh, this European company, they have great tech, super smart founders, but they just don't get the same attention as my US companies. And I was like, yeah, they're not flashy enough. They need to get a TED Talk and like get out there and talk about how they're the greatest thing that's ever happened to humanity. But instead, they're usually like super humble and talking about optimizing and efficiencies and stuff. So I think, maybe they need a little bit more bravado. Maybe they get that deal size up.
Being reasonable is a major character flaw, is what you're saying.
At least we were trying to raise VC
If
money.
you're
Everybody
raising
wants to
money.
be inspired.
Okay, this is fantastic. We have some good audience questions. Folks, if you still have any more, please put them in the Q&A tab, and we're gonna run through these now. We can take a little bit of time with them. From Scott Bryson, can you discuss the early stage infrastructure project financing? This is still really hard. Where do we find LPs that are open to this?
Yeah, that is really tough. And I almost think that it's not the LPs to go after because the pattern that we've seen is that it's really the off-taker that matters. Like we speak to a ton of companies that are raising their folks and they all say like, I go to my financer, they tell me how much of my capacity they want to see firm offtake for. I go and I find those off-takers and then I get the money. So I think if you have offtake lined up or if it's tough, if there's only like one group that can give you offtake, and I'm thinking of something like, a physical solution for the grid or where you need the utility to buy the power, this kind of thing. I think the LPs that you have to look for are the ones that have done something like that before. And so, you see that Brookfield has given money to Infinium. That means they've done a ton of due diligence on SAF. So they probably know that pretty well. They can probably get, they know what they're looking for. So that's, I think, the key thing is find somebody who's done it before and lock in that offtake if you can.
Okay, so this is going back over a little bit some of the stuff we've already talked about, but from Jonathan Cooney and Matthew Grexick, what's driving the de decrease in VC activity and what factors are needed to reverse it? And then related to that, we see VC is constraining infrastructure fund activation, the lack of VC. For first of a kind projects, are there still active VC deals occurring? What sectors besides energy, right? So how is and
Yeah.
on follow on to that is how is PE participating now? Like what sectors, deal sizes, et cetera?
That's a great question. I didn't really touch on PE, but there is some stuff in the actual report. So on the decrease in VC activity, I think that there's a lot of factors going on here. I think that you're seeing a bunch of people who raised when climate was like the hot thing, and those investors have just moved on to the next hot thing, which is probably like AI for absolutely everything and chips. So that's kind of a natural, like the tourists have gone home kind of question. But in terms of like the smaller rounds being raised, I think there is almost this sense floating around that we have everything that we need for, net zero. And it's not totally wrong because I think we have the technological answers to a lot of what we need in order to get to net zero. But there's a lot of questions around the business model and how do you deploy it and what's the smartest way to like fit it into existing infrastructure. So I think it's a combination of there's nothing more to do here, it's not hot anymore, and I'm worried about policy. I think those are basically the driving factors. For the folk projects, there are still VC deals that are happening. I would say that we have seen more and more of them moving to Europe. So often it's like a US company that is now thinking about deploying in Europe. The ones that stick out to me is that you're still seeing deals for long duration energy storage. And a lot of that is because it's tied to data centers, but you're also seeing for industrial heat as well. And that is because there's a lot of industrial users in Europe thinking about that increased carbon price. So they're thinking like, okay, how can I decarbonize my heat? What am I going to do with this? P is kind of sitting in the middle of everything, and they are really looking for like the special deals that allow them to participate in some way in things like grid tech or things like nuclear and geothermal that are like on the edges of that project finance jump. So kind of a like middle ground.
Jacqueline's asking if there are any hedge funds focused on decarbonization themes and generally what the LP appetite for publicly traded funds in the climate space is.
Oh, that's a great question. We haven't looked at that as much, and I can't think of any hedge funds off the top of my head focused on decarbonization. I remember there was a big spate of ETFs that were created a couple of years ago around a lot of decarbonization tech, particularly like transport and circular economy was a big part of that. But for that one, I think we're going to have to check the database and come back to you, Jacqueline.
Okay. Last thing about this sort of VC model from Na Lee, is the traditional VC model for climate solutions overrated or underrated?
Oh, somebody wanted to play the game with us. We should have opened it up to
That's
everybody and
right.
had them do like quick fire rounds. Um, I think the traditional VC model right now is probably overrated. I think a lot of people want to stick to their model and find technologies that fit within that. Um, but I think there's already been a lot of innovation around how you do VC. Like this idea of having accelerators and having incubators, like we're seeing a lot of changes in how companies and investors are trying to support projects. But I think because we are entering this space where so much of the attention is shifting to big projects, I think VCs will have to get a little more creative there, like maybe going in with some partners and figuring out how a bunch of like blended project finance could work. And I also think that CVCs are a very interesting aspect of this as well, because they have always kind of gone into investments by saying, yeah, we're going to give you money, but we're also giving you like access to all of our expertise. And so I think that's a really interesting way that you can potentially help to accelerate a lot of projects without having to put in the same dollar figure as you did previously.
I love that. And maybe just to follow on to that, do you see a role for blended finance policy support instruments to help de-risk investments, particularly in frontier markets, either on a fund level or on a project slash investee level?
Yeah, that it's super important because um, the sense that I'm getting right now is that because there is so much uncertainty and because the shift, especially to like other markets, emerging economies, is happening quite quickly. There's a lot of uncertainty and people don't want to go into it on their own. So when I think about like the way that blended finance can work, I think of like the Stegra deals as a kind of example of how this can be really good. There was like offtake involved. There were like government linked funders involved, and there was a lot of like, you give this money, I'll guarantee this money. So it's definitely the best way to help spread out the risk of everything. And I think you're going to see a lot more of it. It's very complicated to do, and I think it's really the only way you're going to get the scale of funding that you need. So maybe something like a project is broken up into phases. First phase is funded by VC. You can see that it's sort of working, and then you have these later stage funders coming in as well.
Um, Daruk also wanted to jump in on the overrated or underrated. He's asking if you can elaborate on why Europe is underrated, besides just
Yeah,
being modest and friendly.
I think that Europe, when I would look at European policy versus US policy, the US policy was always like very generous. It was giving climate tech a ton of money in the times when it was giving climate tech money. And you would look at European policy and it was like very smartly set out. And like the German carbon contract for difference is a great example of that. It was incredibly complicated. Um, and it was like, okay, this is all related to the carbon price. And if this thing that you're making actually becomes cheaper, then you have to like pay some of it back effectively. And we're only doing this when there's like an imbalance. So I think Europe is seen as a place that is quite bureaucratic and very difficult to operate, and where change tends to happen very slowly. Whereas it's like if you want to get stuff done and move fast and get a ton of money for your project, you go to the US. So I think that slowly model has been difficult for tech that is so disruptive. But I think just the stability of it is becoming very valuable. And I think European governments are also waking up to the idea that if they now need to be worried about their domestic production and their security, then what they really have to do is start developing all of these technologies. They can't just incubate a startup and then have it get bought by an American company because they're losing that IP, they're losing that capability to build things. So I think the fear of loss of IP, loss of strategic technologies, deindustrialization is going to push Europe to be more aggressive.
I love that. Okay, I'm going to lob a sort of open-ended softball at you so that you can close it up with whatever thoughts you might want to end on. But I was just reflect. So Kim, our CEO, Kim, talked to Bloomberg and made this point that there's this vibe, this feast or famine vibe. And
Mm.
there's a part in the report where we talked about, the VC zombie funds where they don't, they're invested, but they haven't raised another fund to follow on. At the same time, you've got these huge numbers from 2025. So can you talk about just the vibes?
The vibes. Um, I think the vibes is kind of everything in every direction at once. There's a sense of like everything is now moving so fast and appearing to come out of nowhere. And then there's some like surprise that pops up out of nowhere. Like some of these nuclear companies going through SPACs, like suddenly SPACs are back. And, these companies are public now. Like, what's going to happen there? Data centers growing so much faster, but then maybe it has to get mitigated because the community groups are saying, no, we don't want these. So I think the vibe is like a little chaotic right now, but I think what's going to shake out of that is a clear direction of like where a lot of the money is going. And I think you're going to have some companies who are like quietly just making progress on their project, raising some money, getting those off takers, getting debt, that's going to mean that I think we're going to be surprised by how innovative um, and how many folks we're going to see at the end of the day. Because if you can ride that data center wave, then you can definitely find the money to get your project built.
I think that's an awesome place to end. Julia, thank you so much for taking us through this report. Everyone, please go to sightlineclimate.com if you haven't already downloaded the report, and you can take a look at it. And you can email me at benji@sightlineclimate.com if you have any questions. I'm happy to hook up the research. Julia, thanks again. And everyone, thanks for coming. It was great to have you here today. I'll send a recording out later and some recap summaries to your inbox. And I think that's it for today.
Thanks, everyone.
Thanks.